Hi, good morning everyone. I think it was 2 months ago since we last had a press conference, and I think there's a lot of changes that has happened over the last 2 months. And I think these are all positive changes. And if I think most of you were here, and I think we were a bit gloomy on our outlook 2 months ago. But there are signs at the moment that are indicating that we may be off to a good start for 2019. Okay? So, just probably give an overview first of what are the positives and negatives that we're seeing. And probably most of are still the same from what we've pointed out 2 months ago. Let's start with the positives. Again, the central agency is really the BSP. And last 2 months ago, the BSP has started to become very hawkish on and very aggressive on adjusting their policy rates. And this has dramatically changed, number one, the view of foreign investors over how the BSP can take control again of the inflation, the worsening inflation in the country. And they became hawkish. They were able to hike rates aggressively. And right now it's 4.75 overnight rate. Inflation was the key theme 2 months ago. And now we've been getting some indications that it has been slowing down, or it has even already peaked probably. Whereas 2 months ago we were saying that this peak of inflation might be pushed forward to first quarter 2019, but I think the government has started to make a lot of measures to address the rice shortage and more so oil prices, which I'll talk about later. And then one key thing that has been progressing is the train tour, the Trabajo Law, and we're quite excited about the prospects of this. But the only thing that's being debated now is if they will include excise taxes on gas or not. So on this new law that will come by next year. Some of the negatives, okay, we've been seeing equity markets move higher because of overall positive sentiment. However, if you go and look at each of the companies that comprise the index, in order for the rally to be sustainable, is we need to have earnings. But unfortunately, we've been getting, as of third quarter, earnings are not as exciting as what we predicted during the first part of the year. In fact, we've been getting a lot of earnings downgrades across the industry from the different analysts. And if we see a lot of earnings downgrades, then it would be difficult for any market rally to be sustainable. So hopefully we can see earnings to turn around starting next year. And then the US continues to hike, but pronouncements last week of the Fed by Fed Chairman Powell been saying that, or giving indications that they may already be approaching the neutral rate. What does it mean? It means that they may see rates stabilizing soon. So that was taken positive by the market. But it doesn't mean that they will stop hiking. I think they will continue their projected Fed rate hikes. I think everybody's expecting one coming this December and another probably 2 or 3 next year. But at least he's already indicating that they may already slow down. Okay? But going back domestically, I think our balance sheet continues to, the government's balance sheet rather, in terms of the current account, is still something that we are watching closely. And this, the government continues to push with their build program, then definitely we will have to import more, and then this current account deficit might balloon further, which again won't be taken in the short term positively. Okay, so at least this is the overview. Nothing really big on the negatives, but on the positives, there have been some turnaround stories already, especially on inflation. Okay, going to the US. The US economy continues to be strong, and that's why the Fed has been on track with their adjustment on policy rates. This chart shows you the dark yellow are the total unemployed workers. It's going down, and then the lighter line shows you the jobs being created. So clearly, the US labor market is becoming healthier. That's why it's fueling the growth of their economy. And we have been seeing that because of this, we have seen the market in the US rally significantly, and at the same time, the Fed has been able to adjust rates higher in order to be ahead of the curve and to combat inflation, and at the same time balancing growth versus how they would want to bring up and normalize their rates. Because remember, they started from zero. So they need to normalize rates in order for the economy not to implode. Okay, oil. This is a big turnaround since 2 months ago rather, where we have been seeing that there's a lot of pressure on the global market for oil prices to go higher. But suddenly, what happened? Are we experiencing consecutive weeks of oil price rollbacks? And again, there's one more. I heard tomorrow a big rollback again tomorrow. So clearly, those are the ones that we're feeling. And the story behind that is apparently Saudi admitted that there has been an oversupply of oil in the global oil market. There's an oil supply glut happening at the moment. That's why the OPEC members have been trying to meet and try to cut down production. Not because to bring up oil prices again, but more so because they don't want to maintain a supply overhang or a supply glut from worsening. And the other part of this is the US. The US has been addressing the concerns on the shale oil. Because previously, shale was the one that has been preventing WTI and Brent from shooting up above 100. But when oil prices shot up, where was shale? The problem in the shale market is that they could not transport the supply. There were no infrastructure to address that supply bottleneck in the US. And they're trying to address that. And hopefully by next year, that can add more supply in the US, thereby adding to the supply of the global oil market. So we can expect oil prices to be at least below 70 for a sustainable amount of time, and probably moving into 2020 even lower, as we see global economy starting to slow down, headed by China. And we still don't know how the trade war will really impact China and the US. Okay? So inflation, again, from the peak of 6.7% in September, we have been seeing inflation adjusting lower. Tomorrow, they'll announce the November inflation figure. Our expectation is about 6.3% for November. This is within consensus. And more so, the important thing on that is the direction of inflation. We're seeing inflation already slowing down, and in fact, probably has already peaked. And this is a change from our previous forecast where we saw inflation worsening probably towards December, but because of what happened in world oil prices, it was able to help us recover inflation faster. So hopefully if we continue to see oil prices going down, then probably our own inflation will really normalize already and hit the 2 to 4% target of the BSP for next year. Um, and the other thing that is crucial here is the government has already passed the rice tariffication bill. So I think it's up for signing, if I'm not mistaken, by the president. So if that happens, then that will also address that near-term supply bottleneck that helped shoot up inflation last September. So if inflation normalizes, and again, this has been the culprit of higher interest rates and lower equity markets in the country, so we might probably see a better financial market outlook for next year. Okay, speaking of interest rates, okay, and we have seen the PSP quite aggressive with their overnight rate, from 3% to 4.75, 2.75% adjustment. And this, we haven't seen this aggressive stance of the BSP probably in the last 10 years or so. And as of late, we have seen the yield curve of the government securities also react positively to this lower oil prices and lower inflation. And we've seen the 5-year rate and the 10-year rate go down significantly by 100 basis points at least. Recent auctions has indicated that 5-year, probably a month ago, hit 8%. 8% rate for a 5-year government paper. But as of the recent auction, the 5-year went down to about 6.9%. So, for one, there were a lot of takers for government securities because they think, investors think that we won't see rates moving up beyond 8% because indications show that inflation has already been addressed, and at the same time, the government has been quite aggressive, or the BSP is quite aggressive in really addressing inflation fears. So the whole market reacted positively and started buying bonds, and that has helped a lot of corporations start looking at pricing for their loans, and it's quite important for us, the economy of the country, to really have not high rates but more manageable rates in order for companies to continue to borrow cheaper to fund their expansion. So again, that's something positive, and we expect the yield curve overall to continue to go lower as inflation continues to go down. So that's both positive on the fixed income and more so on equities, because previously, if you have a 5-year government paper that's yielding you 7 to 8%, a lot of investors have moved towards looking at bonds more than equities. That's why now, as rates starting to go down again from the initial spike that they had over probably a quarter, now we can see the refocus of investors towards the Philippine equity market. Okay? Then moving on to the currency. Even 2 months ago, we've seen that the peso was trading at 53.50 thereabouts. Now, it's at 52.40. Almost more than 1 peso appreciation. Again, there's a lot of factors that affected the sudden appreciation of the peso. For one, it's foreign funds coming back in to the market. Foreign funds starting to buy not equities but fixed income. That's why we have seen a demand for fixed income or bonds bringing down yields. And the other part of this is the view of foreign investors now is the peso will be more stable moving forward. That's why the hesitation before to invest locally and exchange your dollars to peso was not there. But now, because of the hawkish stance of the central bank, the BSP, as well as rates starting to go down, they think that the peso will start to stabilize. Thereby, it's safer for them to start buying government securities first, and I wouldn't be surprised if they start looking at equity markets after this. So, with the mix of foreign buying coming in and seasonality that OFW remittances starting to come in, we might expect the exchange rate to hover around these levels, moving on to probably first few months of next year. Okay, so clearly there's a big change in appreciation of the peso against the US dollar, and this has really affected positively the economy of the country. Okay, so again, we expect it to really be stronger in the next few months or so, given the factors that I've mentioned a while ago. And again, I'm banking on the fact that we might see a resurgence of foreign funds coming in as the refocus from developed markets moving into emerging markets. And we've seen that trend coming into Indonesia. Hopefully, we can see that trend moving into the Philippines as well. A lot of foreign investors are now assessing their possessions on developed markets because, as you see, funds usually just do switching from in terms of relative value. A lot has already been gained in developed markets. In the meantime, emerging markets continue to trade very cheap, including the Philippines. And in fact, the Philippines was once one of the worst performing equity markets this year. But now, it has recovered from a low of about 6,800 or 6,700. Now it's trading at 7,500 today. So clearly there's a lot of changes, and this is happening very fast in the market at the moment. And a lot of it has to do with flow of foreign funds coming back into the country. Okay, in terms of our view on growth for next year, well, we continue to expect strong GDP growth. For this year, we expect GDP to probably average about 6.1%. This has been adjusted because of slower consumption because of inflation adjustments. But next year, we expect the economy to grow at about 6.4%. This will be fueled by the first half midterm election spending. We expect it to fuel consumption growth, which has tapered off a bit this year because of higher inflation. But next year, we're quite optimistic that consumption-led growth will start to move up again, together with the aggressive stance of the government in its Build program. And we expect this to materialize after the elections, because remember, there's a blackout period from I think from November until election, that there won't be any new contracts. So after May, we expect it to continue and in fact accelerate as the midterm election has been decided. So with government spending and the resumption of strong consumption growth, with lower inflation, we expect GDP to continue to fuel the growth, consumption and government spending to fuel the growth of GDP for next year. And we're more aggressive for our 2020 target, as we expect hopefully to see a 7% GDP growth by 2020. And this is again a confluence of more aggressive government spending and private investments moving forward. well, consumption will continue to be a driver for GDP, but I think it will be more pronounced for government spending and um, private investments. Okay? So, in terms of consumption, as I mentioned a while ago, it has slowed down a bit because of inflation. And we all have felt that. We were hesitating to buy more because goods have started to become more expensive. And we expect this trend to reverse starting next year as we see inflation moving lower and becoming within the trading on the band of the BSP between 2 to 4%. Although our forecasted inflation average for next year is about 4.1%, it may adjust lower if the government is really successful in their rice tariffication and as well as if oil prices continue to remain lower, which our forecast is saying that it will hopefully remain lower because of more supply and less demand for oil. Okay, so going now to the PSEI, and we've observed that the equity market has been trading at probably a band of about 1,000 points, from 8,000 to about 7,000. It touched briefly about 6,700, but it's always quick to recover back to 7,000. And a lot of the news has been about inflation, that it has adjusted markets lower. It has affected the listed companies in terms of their costs. That's why the bottom line earnings have really gone down. So we would want to probably see the PSE move above this range for next year, hopefully, but it is contingent on the fact that companies should start to have earnings growth. We may see a lot of drivers on the macro front in terms of higher GDP, funds flow coming in because of rebalancing by foreign funds, as well as the peso continuing to stabilize. However, what would convince us for this market to really breach the 8,000 level again is to see higher earnings growth forecast for 2019. However, we only expect probably about 11 to 12% earnings growth for next year, and we continue to see earnings downgrades. And these different colored lines are representative of different years, where it represents earnings forecasts of analysts. It starts with a higher earnings, then as the year progresses, they adjust lower. It happens on every year. So it's saying that we're bullish during the start of the year, then as companies start to report earnings, then they start to lower earnings forecasts. And it's translated into the price. So usually during the start of the year, everybody's gung-ho, markets move higher, and then as you see quarterly earnings results, we start to see adjustments. Okay, so once we would want to see these lines reverse, that there would be more earnings upgrades than downgrades. In order for us to convincingly say that we can see a more sustainable rally for the PSEI. Because we can see rallies definitely, but the question is sustainability. What we would want to see is more sustainability rather than just shoot up above 8 and then massively correct again after a few months. What we would want is a steady trek, and the only thing that can support that rally is earnings should be produced and earnings should be higher. Okay? So, having said that, clearly there is a strong case for us to say that the market will move higher from where it is right now, especially for next year. But based on our bottom-up valuation, our valuation for next year is about 7,900, given where earnings forecast is at this point. Okay? But what I'm saying is this 7,900 may overshoot, definitely because of better sentiment towards emerging markets and more so towards the Philippines as the government addresses inflation. The peso continues to appreciate, but the point is we would want to say that it can be sustainable if it is supported by strong earnings growth. And the strong earnings growth, we have been seeing that it is being capped by higher competition, higher costs, and it's not really translating into better growth for majority of the companies. They're capturing it on the revenue side, but not on the bottom line. So we can see 7.9 hopefully breach if most of the major players start to have better earnings. Okay? So to summarize again the points, at least in the near term, we expect foreign inflows to start coming back in both on fixed income and I think the next wave would be equity markets. So please expect foreign fund buying coming back in towards the latter part of December and more so for January. Okay, I highlighted Bulacan Airport, but just to prove a point that the government is really keen on their build. And they're starting to really, now we can see that projects are being awarded. Okay, previously, we have been talking a lot about certain projects, but the Bulacan Airport probably is one of the major projects that has been awarded, but subject to Swiss challenge next year, but at least the government has acted on it. But we may not see this in the next 10 years, but at least they've started. And more to come. Okay? In terms of interest rates, we expect the BSP to, after hiking policy rates, they probably would stop next year and resume the reserve cuts. So we expect the BSP to cut its reserves, and that would benefit banks and would add more liquidity in the system. Okay, and I think that has been also announced by the central bank governor that he will have to start and resume again the reserve requirement cut. And the target is a single digit reserve. We're at about 18%. They would want to bring it down to a single digit number in the next 2 years or so. Election-related spending, again, every election year, we expect consumption spending to be heightened. And this will definitely be not as big as a national election year, but the midterm election year will also see more spending, especially on the provincial areas. In terms of headwinds, in terms of higher US rates, we expect it to be still on track, but again, as the Fed chairman announced last week, they might be seeing almost the end of their rate cycle tightening soon. So that will be positive for markets moving forward. But in the near term, we expect that to provide some headwinds and volatility in the market. This has been a lingering concern. Equity markets in the US continue to be trading at all-time highs. And of course, markets need to correct. And even if we have been battered, or Asian markets have been battered, if the Dow Jones corrects, we also would correct. Okay? So that might derail a bit some of the rally that we might expect for next year if in case the US really corrects. Okay? Trade wars, again, this is still uncertain, but over the weekend in the G20 summit, there has been a truce, at least by US and China, that there won't be any additional tariffs. So this has been taken positively by markets today, and I think the Dow Jones futures are already up more than 1%. So we have yet to see that in writing. Again, they made pronouncements, but we have to see that in writing on how this will progress. But again, it's still a headwind because of the uncertainty how it will affect Asian markets, more so for the Philippines in general. So overall, a lot has changed in the last 2 months, and more for the positive. And a lot of this has to do with the view on oil prices, the view on inflation, and the view on interest rates. And these three factors have been the culprits on why equity markets were quite volatile for 2018. So hopefully with these three starting to be addressed, we can expect better markets or less volatile markets moving into 2019. Okay? So this is the last slide. I will leave you with our forecasts for 2018 and 2019. So year-end forecast, again, GDP, we're at about 6.4, moving into probably 6.6%. And 2020, we're hoping at 7% GDP growth for 2020. So I would end here, and
further questions, please hold on to them as we will be allotting time later for one-on-one interviews and roundtable discussion.